Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Seth Wunder. He's a chief investment officer at Acorns to discuss the disconnect between the market and the economy. Seth, it's great to have you back in studio. Welcome to Trade Talks.
Thanks.
And before we get to that disconnect, how quickly is the economy slowing down at this point?
I mean, quite quickly. I mean, you look at housing with the rise in interest rates. You've seen home sales starting to touch lows that we hadn't seen since 2008. You've seen producer price index numbers come in quite considerably, the retail sales numbers. So a pretty wide swath of the economy is flashing recessionary signals, which is kind of a good thing because then it takes pressure off of rates and inflation and so forth.
Right. So what should investors be focusing on when it comes to the Fed?
The fact that the markets realistically have priced in a fair amount of the risk already. I mean, if you look at where the Fed is implied on their rate move, the next increase will be almost 5%. And if you look forward to inflation, which I'm sure we'll talk about, you're going to see numbers way lower than where the Fed funds rate is. So the Fed's probably done at this point or close to done. And so from an investor perspective, thinking about what's next is really the opportunity where you make money.
Do you think the market is disconnected from the economy? It seems as if the Fed really hasn't announced that they're going to change course yet. And it feels like the market wants it to, almost like a self-fulfilling prophecy, but they haven't really made any changes to their policy yet.
Yeah, so history tells you that like the markets at turning events does disconnect from fundamentals. So if you look back in 2009, the market bottomed in March. We didn't actually peak in unemployment until the October timeframe. And so when you go through peaking cycles and bottoming cycles, you get that disconnect period. I think the market is trying to anticipate that the Fed is done. Now, when they are, and if the economy does hang in there and we get a little bit of a Goldilocks outcome, there's still plenty of opportunity for risk assets to do well.
Right. So investors, I mean, we discuss this all the time, should stay invested and ride the course because markets typically go through cycles. They just don't move to one direction to the upper right of the chart. This is more, sometimes we hear volatile markets or the market's not acting normal when in fact it is. Markets just don't go up every day.
Yeah, so if you look at the market's long-term return, it's, let's say, high single digits. If you reinvest dividends, it's a little bit higher than that. But if you look at how many years the market actually returns its average, it's only about 10% of the time. So using volatility to take advantage of being consistent in dollar cost averaging or being invested for the long term is the normal pattern most investors should take. Right. Thinking that every year is going to be the average or normal is not the right mindset to think about. Right.
So what sectors or what areas of the market look most attractive?
Well, so what we'll start to get is as you get past the interest rate sensitive and the cyclical sectors that have come back in because people are worried about the economy, those can do a lot better than what we've seen. Tech has been beaten down quite considerably and growth more broadly as rates have gone up. So as you normalize both cyclical headwinds as well as the rates, you could actually see a broader swath of companies all do well. That's when what we breadth and the breadth of the market expands. That would be a sign of a healthy market to come. So
it sounds like the market is pricing into your point. It's a forward-looking mechanism. We've passed peak inflation. We've passed the severity, the velocity of the rate hikes is what it sounds like.
Well, so look at it this way. The last 6 months of CPI has actually been flat. So if you were to take the next 6 months, now we have the economy slowing down, you have housing, you have retail sales, even wage inflation now is starting to slow down. If that trend were to continue by May, CPI would actually be less than 2%. So for the Fed to feel the need to keep going as the CPI data continues to cool reasonably quickly, I think would probably be short-sighted on their behalf. And so the market is trying to discount that.
Because 2% is their target. Right.
2% is their target, right. And also it would be almost 250 basis points of restricted policy above that. So not only would they be a target, they might actually be offsides in terms of where rates are. So we'll see as we get there.
All right, Seth, appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.